Today I wanted to talk about DIVO, Amplify's Enhanced Dividend ETF. I wanted to share with you how much DIVO you need to own to be able to achieve $1,000 a month. And then I wanted to compare DIVO with QYLD, with QYLD being one of the most popular 12% dividend yielding funds, with the most recent dividend yield being close to 27% at 50 cents per share, which is twice as much as it has been in the past. So I'm going to compare QYLD with DIVO, and then I'd like to talk about if you should be investing in DIVO or not. So let's get started. So DIVO is what they call a covered call ETF, and right here DIVO is explained as an actively managed ETF of high quality large cap companies with a history of dividend growth, along with a tactical covered call strategy on individual stocks. DIVO is strategically designed to offer high levels of total returns, meaning growth and dividend distributions, on a risk-adjusted basis. If we take a look at DIVO's holdings, you'll find out that there's actually only 28 holdings, with the top holding being United Health Group. They own 129,000 shares. You go down the list and you see other very large companies that pay a very decent dividend. We come down on DIVO's webpage and we see their sector allocation. They're spread evenly across the board in many different sectors, with the IT or information technology being the largest, but only by slightly. And then we check out their cumulative performance and their annualized performance. And I believe the annualized performance includes the distribution with the growth of the stock. And you can see it actually underperforms an S&P 500 fund, but it outperforms most of the covered call ETFs out there, with the CBOE S&P 500 Buy Right Index being the benchmark for covered call ETFs. DIVO actually outperforms the benchmark, but it still underperforms the S&P 500. So let's see how much DIVO you need to own to be able to achieve $1,000 a month. And later on in the video, I'll talk about why you might want to own DIVO. Even though it doesn't outperform the S&P 500, you still might want to have DIVO in your portfolio, and I'll explain here in a little bit. So this is my single fund investing calculator, where DIVO being the ticker symbol. I have all of the fund stats in here. Today it's trading at $38 per share. The current dividend yield is 4.83% with an expense ratio of 0.55. The dividend frequency is paid out monthly. So every month you would get about 15 cents per share, with an annual total payout of about $1.84. Now the growth and contribution are the numbers that we can change around to be able to see how much we would have in a projected 1, 2, 3, up to 10 years. And then on my long-term graph, I have 1 to 50 years. So if we play around with these numbers right here, we have the dividend yield input right here. And let's say we change the annual growth rate to about 10%. If we check out DIVO's overall growth rate over the past year, it's been close to 13%, but it hasn't been 13% since the inception. Cumulative return over the past 5 years is 51%, so that would be an average of about 10% per year. And then the fund only began at the end of 2016, beginning of 2017, so that's as far back as we can go. So if we want to play around with a growth rate, we have to keep it below 14%, so let's go 8.5%, and that is what we could expect from DIVO with dividends reinvested. A $10,000 investment will get you close to $32,000. Without dividends reinvested, you would have close to $21,000, which again does not outperform the S&P 500. And then over here, we have our dividend calculation. If you wanted $1,000 a month or $12,000 a year in dividends, you would need to own close to $248,000. Okay, so let's now compare DIVO with QYLD. So I split my screen here. Over on the left is DIVO's holdings, a summary of them, and then over on the right is QYLD's holding. Now this allocation right here, or the holdings breakdown, might differ a little bit from what Amplify's website says, but it's fairly close. So you can see the difference between QYLD and DIVO. QYLD obviously follows the NASDAQ 100, so it's going to be very tech heavy. DIVO only invests in 28 funds, and their strategy is to invest in large companies that pay a dividend. So QYLD's strategy is to buy holdings in the NASDAQ 100 and do covered call options on them. So QYLD is going to be very tech heavy. So if we come down here and check out their top 10 holdings, we can see there is some crossover, but with QYLD having 103 holdings and DIVO having only 28 holdings, with the top QYLD holding being Apple at 12%, and the top DIVO holding at 7.36%, United Health Group Incorporated. So we're going to compare QYLD with DIVO over on my fund versus fund investing calculator. So on the left side here, fund number 1, we have DIVO, and on the right side, we have QYLD. Very similar to my single fund investing calculator, we have the fund stats here with the annual dividend for DIVO being $1.82 and the annual dividend per share for QYLD being $2.68. Now on the growth and contribution, DIVO, we're going to knock that down to about 8.5% like we did on the other graph. And QYLD is very interesting. Most of QYLD's return is going to come from your dividend yield. Over on Seeking Alpha, their cumulative growth has been continuing to decline. After the market crash in March of 2020, QYLD has struggled to come back to pre-coronavirus numbers, and I think people are abandoning this fund due to its very poor growth rate compared to maybe some of other Global X's funds that are covered calls, such as XYLD and RYLD, outperforming QYLD by a large margin. So I think for them to recover this fund, they have to continue to pay a high dividend for you to be able to get any yield whatsoever. So the tricky part here is guessing what the annual growth rate for QYLD is going to be. So I'm going to try to get QYLD and get it as close to 0% as possible. If we do it at 0%, it kind of breaks the calculator. Over here on the graph, you can see that DIVO outperforms QYLD, even with QYLD having that 12% dividend yield. However, if we start to give QYLD some growth here, let's say we give it a 1% growth, and remember, this is a 10-year graph, so after 10 years, QYLD will come closer to DIVO and they don't separate as much. But if QYLD continues to perform well, I would suspect if QYLD performs well, DIVO will also perform well. Because DIVO, remember, has been outperforming the CBOE Buy Right ETF or the benchmark for covered call ETFs. So DIVO has been outperforming that, but still underperforming the S&P 500. The only way for QYLD to pass DIVO is if QYLD were to have some consistent annual growth rate. They would probably have to continue to increase their dividend yield, and they would have to continue to share on their premiums that they receive when doing the options on the funds that they hold by paying it out in a dividend. And they would continue to produce a higher dividend yield. Let's say it was closer to an average of 15%, then I think it would become more attractive to own QYLD. And time will tell, because here in the first month of January, like we talked about, QYLD reached 50 cents for a monthly dividend distribution, and if this continues in 2022, I would suspect more money to flood into QYLD, which would push up its net asset value, or the NAV price, which would give it a little bit more annual growth. So at that point, QYLD would outperform DIVO, but they're still tracking fairly close. And that's with a 15% dividend yield over the course of 10 years. So I wanted to share this illustration with you to help you understand why you might want to invest in covered call ETFs. And this is a sketch pad here. I'm going to draw a line the best I can here. I always think about investing in stocks as the same as investing in real estate, but it's not a tangible asset. Your stocks is something that's kind of more like a digital asset. So let's do real estate up here in the top. So we'll do real estate. So this is your physical property. It would be owning a house and renting it out. And this would be your stocks right here. So we'll do stocks, and then we'll just do. So when you want to invest in real estate, let's say you're starting from nothing. So this would be $0. And then real estate investment, let's say you wanted to invest $250,000 into a house. So let's say with a $250,000 house, depending where you live at in the United States or in the world, you can get a rent of about, say, $1,000. Let's say you wanted to go a little bit farther and you wanted to buy a $500,000 house. And you feel like with a $500,000 house, you could obtain $2,000 a month. Let's say if you had $1 million in real estate, you could get $10,000 a month. So now in your stocks here, let's say you start off with the $0 and eventually you build up to a $250,000 portfolio, right? Now, obviously the numbers are not going to be the same here. You're going to have less maintenance fee It's not a tangible asset. You don't get calls at 3 o'clock in the morning because your toilet overflowed or something like that. So let's say for $250,000, you can have somewhere between $100 and $500 a month. And you might think, oh, that's a little steep for $250,000. Well, especially for those high dividend yielding funds, this is not too far off, and I'll show you right here. Over on our fund versus fund calculator, DIVO versus QYLD, for monthly dividends, $100 a month, you would need $25,000 of DIVO or $8,000 of QYLD. $500 a month would be $125,000 of DIVO and $40,000 of QYLD. So let's say you wanted to get to $500,000 in your stock portfolio, same deal, $1 million, and let's say your retirement number is $2 million. Okay, so the goal here is retirement, right? And whether that be all the way up here for you or whether that be all the way down here for you. All right, so how fast do you want to get to retirement? If you can get to retirement, let's say it's $1 million for you, and let's say you invest in a fund like DIVO or an S&P 500, which remember, we saw on DIVO's website, they even claimed themselves that they underperformed the S&P 500. So let's say you want to get to $1 million. If you invested in an S&P 500 fund, you would get to your retirement fund a lot faster. However, with DIVO, you would get a higher dividend distribution per month all the way up until retirement. So let's say it takes you 30 years to get here. With the S&P 500 fund, it might take you 35, 40, 45 years to get with like a covered call ETF like DIVO. So hopefully this little example helped you out a little bit to be able to understand the difference between a covered call ETF and an S&P 500 and why you might want to invest in DIVO, why you might want to forego investing in DIVO and just invest in an index fund, a very safe way to be able to grow your portfolio. And to round it all out, I want you all to let me know in the comments which fund in 2022 do you think is going to outperform the other? Do you think QYLD is going to turn it around and be able to increase their dividend yield and have more people invest in QYLD, which would eventually put QYLD over the top over DIVO? Or do you think DIVO is going to continue its steady growth with its steady dividend payout and outperform QYLD? Head down into the comments and let me know. And thanks for watching.